come over and talk about the new international tax reform and what's happening and what we can expect with the changes that Trump is making.
Thanks, Rebecca. Can everyone hear me all right?
Yes.
All right. Thank you. We're going to talk about tax a little bit. And Benita did a great job of outlining some of the typical tax issues that come up when you do cross-border transactions, growth, or planning. We're not going to talk about that during my section today. Is that a little better? Is that a little better? Okay, great. Thanks. We're going to talk about U.S. tax reform in general, but mostly how it's going to impact international tax from the U.S. for multinationals based in the U.S. and multinational enterprises investing in the U.S. So our agenda for my little section will be an overview of the current system so that you can understand what some of these reform proposals mean in comparison to what we have now. Key aspects of the tax reform proposals and what we think is going to happen next. And you know, there's a tremendous amount going on right now. If you pick up the Wall Street Journal, any global financial press, turn on the news, turn on the radio, you're hearing about tax reform right now, and it's a very, very live topic. I mean, as we all sit here right now, we had the House bill, 400 pages or so of new tax legislation, come down just on November 2nd. Before we could even digest that, we had a new chairman's mark within 24 hours that took out, for example, something you might have read about, which was a provision that was going to override most of the U.S. tax treaties in certain circumstances. Very controversial. That was gone in about 20 hours. Since then, the following Monday, another House proposal. We had just last week the Senate, not the legislative language, but a description of proposals, and that's in markup right now. We expect a new chairman's mark today. Don't worry, I'll cover all this again later. But that just gives you a sense that, the idea is the House will maybe have a floor vote this week. The Senate will try to have a vote after Thanksgiving. And they want to have this on President Trump's desk by Christmas so that it can be effective next year. This is breathtaking speed. The 1986 Act, and if you're curious about tax reform, I recommend a book to you called Showdown at Fuji Gulch. It's really terrific. It's a breathless account of the 1986 tax reform in the United States. It's much better than it sounds. But that took 18 months, and depending on some measures, almost 2 years to get done. We're doing now in about a month, really potentially broad sweeping U.S. tax reform. But what's our system like right now? Most of us have a sense. The two big things that we hear all the time about the U.S. tax system, and India competes with us on this, but are high marginal, nominal rates for corporations, 35%, is really where you get very quickly in the U.S. for a corporate, and a global tax system. Now, the global tax system is almost unique among developed economies. Most countries do something to favor foreign investment and to leave alone and not tax again when they come back to that home country the profits and gains from the foreign operations. One example, for example, very typical is the Netherlands, where you can get dividends, interest, royalties, you can have capital gains on sales of foreign subs out of the Netherlands, all with no Dutch tax. The U.S. is the exact opposite. The assumption in the United States is that everything will eventually be taxable here. Dividends when they come here, capital gains when you sell a foreign company. Now, because we do respect separate corporations and separate companies, going all the way back to a Supreme Court case called Moline Properties, you can achieve deferral. Of course, we have a whole group of anti-deferral regimes that everything's like a chess match. You move your piece and the government moves their piece. But we can achieve deferral by having earnings offshore in certain structures and deployed in certain ways. But the idea is that eventually all that money that's out there will eventually be taxed in the U.S. That's our base case right now. You may have read in a lot of the drumbeat that's leading up to tax reform that one of the reasons U.S. tax reform is important is because there's between $2.5 and $3 trillion U.S. locked up offshore. That's because of the deferral structures I'm referring to right here. It's often referred to as the lockup effect. Before they redid all the accounting rules in the U.S. or GAAP, it was called the APB 23 amount, so it's a permanently reinvested amount offshore. We're going to talk in the reform proposals about what's going to happen to that $2.5 or $3 trillion in just a minute. But what this has done, this high tax, the global system where you don't really want to have a U.S. operation with any foreign operations under it if you can help it, has led to inversions. That's when companies leave the U.S., they expatriate, and through a combination or through an acquisition, try to set up their headquarters offshore. The reason that a company would do that, there are many, but one of the reasons, one of the strongest reasons, is that you can then try to structure your operations, at least going forward, so that your non-U.S. operations aren't underneath the U.S. company, and they won't be subject to that global tax we just talked about. But even, we all know that the U.S., both the Congress and pre-the Obama era Treasury Department had a lot of rules to try to clamp down on inversions, and some of them were stopped. Some of those rules are being rolled back now, but even apart from inversions, forget about inversions, this global system with high tax rates can lead to U.S. companies looking like plum targets. Because if you buy that U.S. company, you can, over time, deploy that business model outside the U.S. in a way that's not going to be subject to U.S. tax. So a foreign headquartered multinational can have that tax advantage. So that's the backdrop against which we're working, and some of the perceived evils that are going to try to be fixed in tax reform. So, two big drivers of U.S. tax reform are going to be lower rates. I just said high rates and global tax are the problem. So the solutions are, are you ready for it? Lower rates and a territorial system. But how do we get there from here? First, let's talk about what those, in addition to going to a territorial system, we've got that $3 trillion offshore we have to deal with, and then we have to think about what the U.S. tax system is going to look like after we go into a territorial system, and that's often referred to as a base erosion concern. So the main proposal on tax rate is to drop the corporate rate to around 20. I mean, right now, as we sit here, both the Senate and the House have settled on 20. That was hard fought for. You may have read, Trump, I think, at some point said, hey, maybe we'll go for 15. In the House, they started to climb up from 20 to 21 to 22, and everybody thought 25 was kind of the soft ceiling on that. But with the proposals that are out now, they settled on 20. But how you get there is by taking away all the stuff that can lower your effective tax rate. But anyway, 20 is going to be the headline rate, we think. The Senate proposal calls for that rate to kick into gear a year from now, at the beginning of 2019. The House proposal talks about right away in January of 2018, assuming we made it past this year. We'll have to see about that, and I'll talk about process again at the end. So, territorial system. Number one, at the lower rate, 20, whatever that means by the time we take away interest deductions and all kinds of other things. But we're going to have a 20% rate, and now we want to have a territorial system. It's not going to be as good as the Dutch system. We're not going to exempt capital gains. So if you have a U.S. company with foreign subs, under both proposals right now, if the U.S. company sells those foreign subs, they're going to have gain in the U.S. The way it's taxed is going to change, but there's still going to be gain here. So it's not a complete participation exemption. What it is for the most part, the ability to get money back to the U.S. in dividend form and some alternatives in a way that's free, mostly. Because, the U.S. has a lot of bills to play. We've got armies all over the world, we've got a lot of costs, and we've got, we've got entitlements and other costs in the United States that we just can't shirk, so our system is still going to be pretty expensive. We're going to have a mostly territorial system with some minimum taxes that we'll talk about later. But to get from where we are right now, remember, $2.5 or $3 trillion offshore right now from the global system that we'd always kind of baked into our plans as being taxed here. So figure more than a third of that was already counted on. To get from our system we have now with those locked up funds to a territorial system, everybody agrees that the way to do it is to pull the Band-Aid off quickly and to tax that offshore stuff once, right now, right away, okay? And the House version, so the difference between liquid and illiquid assets, if you think about, not to name names, but if you look at maybe your cell phone, piece of fruit that you may own their products, they're well known to have really a lot of cash offshore in their structure that used to be a double Irish structure. A lot of it's in cash. Now, they don't have a lot of brick and mortar or factories or things like that. So companies with highly liquid assets offshore, under the House version, are going to be hit with a 14% right now. 14% one-time tax. Under the Senate version, 10%. So whether it's going to be 10 or 14, somewhere in between, we'll find out. But that's a higher rate than the 5 or 7% that's going to be levied on illiquid assets. Or, you go through your cash equivalents, readily tradable, all that kind of stuff, AR, and after that, everything else will be subject to a lower rate. That's to recognize the fact that some companies do have a ton of money permanently invested offshore, but they've got factories, they've got warehouses, maybe they have ships and other things like that, tangible stuff that they can't just convert into money to pay this bill. The other thing that's going to happen with this bill is in both provisions, right now, you've got about 8 years to pay it, which helps. But that's going to be, just as a footnote here, I really want to get across to you the key things that are happening, but a little bit of insight. Think about what happens right now. We've got financial centers in many places, Mauritius being one of them, Singapore others, underneath which a lot of these locked up funds are located right now. Everybody who works with multinational enterprises know that one of the main things companies think about when they do any planning is how do I make sure I don't accidentally or inadvertently subject any of that money to U.S. tax in this transaction. Once it's all taxed, right across the board, whether it's 5 or 14%, it's now pre-taxed money that can come back to the U.S. and be deployed creatively without any thought to the U.S. tax consequences. That could create a sea change in the way that money moves around the world in the next several years. All right, now, we've lowered our rate. We've hit the $3 trillion with a tax rate. Companies are all figuring out how to pay that over the next 8 years or so. And what do we do going forward? Well, if you think about it, right now, there's an incentive to make money offshore because you can achieve deferral, even though it's going to eventually be taxed in the U.S. But once you bring dividends back to the U.S. for free, there's a huge incentive to make money outside the U.S. In fact, to the extent you can earnings strip and move everything outside of the U.S. and bring it back for free, you'd be tremendously better off, right? Well, they thought of that, of course. And so, in addition to creating all these bridges for capital to move outside the U.S. and be deployed more efficiently like it is under the tax systems of most of our competitor developed economies, we have to also kind of build a wall or a moat or at least a little hedge around our tax base to make sure that it just doesn't, we don't wake up one morning and the entire U.S. tax base is gone. And that's called base erosion protection. There are a number of provisions. We're not going to go through them all, but there are a number of provisions in these proposals designed to take on base erosion. Now, one, for example, are outbound payments to affiliates. We talked about transfer pricing a little bit, the concept that parties should deal with each other at arm's length, and that's not going anywhere. But we're going to maybe give that some starch under these U.S. proposals by looking at certain transactions between U.S. companies, whether it's a parent, whether it's a sibling, whether it's a sub, it doesn't matter. All that, remember that top-down thinking in the U.S. tax system of always thinking about the U.S. parented group, that's kind of out the window now that we're going to a territorial system. So now we're looking at peer relationships, affiliate relationships, with this expanded global financial group concept. And we're going to hit, on the House version, many of those intercompany transactions with a 20% excise tax. So you think about your Honda minivan that may be finished off in Marysville, Ohio. The supply chain for that vehicle goes around the world probably a couple of times. All of those payments to affiliates for parts and services are potentially, many of them, are potentially subject to this excise tax. This is going to be a big issue. It's already softened, though. We saw in the first chairman's mark out of the House, they expanded the amount of foreign tax credit that's going to be available. This is the kind of horse trading that's going to be happening over the coming weeks. The Senate has a special tax on outbound payments of interest and royalties to hybrids. Little taste of BEPS there, which is the OECD's attempt to avoid unreasonable profit shifting and base erosion globally with this concept of paying to a hybrid being disallowed or having a sting tax in the U.S. And a special 10% kind of base tax in the Senate bill on payments for deductible services or depreciable property. Now, we talked about interest in the U.S. being one of the things that can drive down taxable income and lift up your effective tax rate, rather suppress your effective tax rate. Both the House and the Senate do two things. They, in general, stepping back from the international provisions for a minute, they in general reduce the value of interest deductions in the U.S. for all companies. But in addition to that, there's a fear that U.S. operations are going to be hyper-leveraged, are going to carry more than their share of debt burden. And remember, again, we're going to this territorial thinking, where we don't just assume everything's going to end up here. So we're very worried about earnings stripping in the United States. And that means, for example, in both provisions, there's roughly about 110% limit. You can't have your U.S. operations more highly leveraged than your non-U.S. operations. operations, where you stand to lose the tax deductions here. Another way to prevent base erosion, and this is what I meant in my earlier slide when I said we're going to mostly a territorial system, because another way to prevent base erosion is to look at certain types of income that a multinational enterprise is going to have and that they might have outside the U.S. and just hit it with a tax while it's out there anyway. And there are several provisions throughout the new reform proposals that do that type of, that serve that kind of function, to hit a minimum tax, either on high return income, like the House provision, which only gives you a credit up to a certain amount, which means in effect, if you're not paying 12.5% offshore on certain high return income, usually intangibles, you're going to pay tax here in the U.S. even before you bring the money back. That's important. In the Senate, they have similar proposals with respect to IP, more specifically calling out IP, which is one of the most mobile types of income, as we all know. The Senate proposal, at least before I came to this meeting today, still included a broader definition of intangibles for certain key Internal Revenue Code provisions like 367 and 482, expanding what's going to be an intangible for certain purposes that cause current taxation. I love this acronym. There's a new concept of income under the Senate bill called Global Intangible Low Tax Income. So that's a kind of income that's going to be out there in the world that we're going to hit with a 20% state tax. But when you take that, global intangible low tax income, the acronym is pronounced GILTY. So it's guilty income. People will say guilty income even though the I is income, but that's going to be taxed on a current basis in the U.S. when there's a minimum, when there's a return on that guilty, that intangible stuff out there that exceeds a certain otherwise reasonable return. We're trying again to prevent the crown jewels of U.S.-owned intangibles from migrating out of the U.S. where they can make all their money and then have dividends come back for free. That's the basic idea. Although that's all stick, we do have some carrot in that the Senate proposal introduces a concept of bringing home IP from foreign operations at low or no cost, which is a brand new idea, so we're going to deem it to be worth just its tax basis and maybe be able to bring it back from those CFCs where it's been hidden for years at low or no cost. And then to the extent you exploit that here in the United States and generate direct foreign income, so you make money here on royalties coming back from other jurisdictions, we're going to give that a special deduction and give it a preferential rate in the United States. Whether that will withstand WTO or not, we'll find out. All this stuff is just spaghetti thrown at the wall. I have to see what sticks. But there's this idea in the Senate, at least right now, of a weak version of a patent box to give you a little bit of a carrot to include global players. So just in 10 minutes or 15 minutes there, we covered a lot of what's going on right now. What's going to happen next? Well, as I said before, the House had its first bill come out now almost 2 weeks ago, or a week and a half ago. It came out of the Ways and Means Committee, which is the tax writing committee of the House, just last week. So it's ready for prime time. It's in the Rules Committee today. And depending on how Speaker Ryan can manage things like potential floor amendments, it could get voted on by the whole House Thursday this week. Might slip till Thanksgiving, but we'll see. That's really important. The Senate bill, which is different, we talked about some of the ways, but just trust me, the Senate bill is very, very different in many ways. The Senate's a much different body than the House, much more contemplative and can be more difficult to reach consensus there. The Senate is in the Senate Finance Committee markup process right now. That's going to go on, we expect, all week. So the Senate Finance Committee is the analog to the House Ways and Means Committee. That's the tax writing committee at the Senate. If we get that out of Senate Finance this week, then it could be on the floor of the Senate for a vote right after Thanksgiving, after the Thanksgiving break. That would be, as I said before, pretty amazing. Now, that'll mean that we have two different bills. They're going to be pretty different, and that means it'll go to conference. The President has stated he wants this on his desk by Christmas, so between Thanksgiving and Christmas, we have a lot of staffers with no sleep, and a lot of conferees working on getting the carpentry done to try to meld these things together. Frankly, in conference, we can see a lot change. We can see compromise, and we can see whole new things come in, and things we thought were going to come out. So this all needs to be watched very closely. So again, just to recap, rates are going down. The U.S. is going to go to territorial. We're going to have a system that really tries to incentivize global expansion of business, unless none of this gets done, which is a distinct possibility. And I want to thank you for your attention, and I'll take any questions in the time that I have left.